Kelsey, Berro, fixed income portfolio manager at JPMorgan Asset Management. Here's how I'm going to start, which I was going to do before that great discussion where you were nodding and listening. So, 16-year highs in interest rates. Yet, historically, 5% is not that high. But we have seen what happens when you move from zero. And in light of what Steve just said, the regional banks again yesterday, go up another 25 basis points, and if there is duration risk left, that just makes it worse. If deposits keep going out and they have to sell some of this stuff they were going to hold to maturity, another 25 basis points marked makes it even worse. Does the Fed take that into account or not?
So I think they are taking it into account, but there's always this debate about should they or will they. In this case, it doesn't really matter what they should do, it's what they will do, and then markets have to deal with the consequences of that. So what they will do today is they're going to hike 25 basis points. The market is priced for about 80% probability of that. What the consequences are is that growth, inflation are going to continue to come down, and banking stress is going to remain. There is a disequilibrium right now between deposit rates, they're still very low, and money market rates, which are at 5%. So even though the Fed has set up this backstop, there's going to continue to be this drip out of the deposit system into the money market funds that is going to continue to put pressure on the banks.
So how many mandates does the Fed have? They got dollar stability, they've got full employment. I thought that in 1907 that it was created for banking stability. So there's at least three. Is dollar stability, i.e. inflation, really paramount right now? Should it be?
So I think right now what they're focused on is financial stability and then, of course, price stability.
Why would they go up 25 basis points if they were focused on financial stability?
Well, I think in their minds right now, they've set up the appropriate backstops in terms of liquidity. The banks are functioning to a certain extent. But what we're concerned about is a credit crunch, is credit being withdrawn from the system. It doesn't happen all overnight. It happens quickly and then slowly. It's this chronic problem that we expect. So bottom line, I'm a fixed income portfolio manager here. What does all this say to me? You have the Fed, which is pausing. They should pause after this meeting, so one more hike and then they pause. We see all the signs that growth is rolling over, all the signs that inflation is rolling over. If yields are going to be rallying, core fixed income is going to perform very well in your portfolio under this environment.
Kelsey, let me ask you, what happens today if they do what the market's not expecting and they actually do pause now? What happens to fixed income immediately?
So I think knee-jerk, you're going to get a rally. Yields are going to move lower. That would definitely be a dovish surprise to the market. But there is going to be, on the other hand, this concern about what does the Fed know that we don't know. I mean, they talk to the banks every single day. We get, on a weekly basis, the deposit data, right? The commercial bank deposit data. They basically see that on a daily basis. So there is going to be this question about what do they see that we don't. Now, there is something right now that they see that we don't. It's the Senior Loan Officer Opinion Survey. We get a copy of that May 8th. They already have that on hand. What I think that's going to show is that banks are really stepping back here. I mean, nobody wants to be originating new loans, especially if your asset mix concentration was very focused on commercial real estate, these areas that the market is concerned with.